Farms.com Market School with expert commodity analyst Mo Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is part 2 of our continuation with defining many of the industry jargons and terminology that you see at trade shows, presentations, seminars, and written material. We're hoping that you can, after these 2 videos, that you'll understand a little bit more about the different terms that the industry uses. So let's start off with fundamental analysis. Again, this is all in alphabetical order. The study of commodities' current expected supply and demand situation in order to help forecast future price movements. Remember, we've talked about fundamental versus technical analysis. You got to use both. Fundamental analysis is basically the study of supply and demand. Hedging, to take an opposite position in the futures market to one held in the cash market. As a farmer, for example, you are long a commodity called grain. Hedging means you do the opposite with futures or options. In doing so, one locks in the price a buyer will pay or a seller will receive for a physical commodity. For sellers of futures, a lost revenue from the higher prices after the hedge is established will be offset by gain in the cash market. The opposite applies to the buyers. Hedge-to-arrive contract, a cash contract, but unlike a forward contract, not all the components of the forward cash price are locked in. Essentially, you only lock in the futures, you leave the basis open. So we've talked about this before. We want you to do them separately. You're locking in the futures, leaving the basis open, or you lock in the basis, leave the futures open, and you determine the futures at a later date. Index funds, large speculative funds that invest on the long side, also known as non-commercial traders. So they're similar to the speculators, except they're following a particular index, like the Goldman Sachs Commodity Index. In-the-money calls or puts. Simply put, remember, a call, you think price is going to move higher. So an in-the-money call, if it's below the futures price, that means it's in-the-money call. For a put, you think the price is going to move lower, so an in-the-money put above the futures is an in-the-money put option. So the put option, or strike price on the put, is above the futures price. Island top. An island top is a technical chart formation that often signals a bearish change in trend. This formation is established when the market gaps higher, leaves a price area between the previous high and the new low where no trade occurs, and over time leaves a gap down. The activity creates what looks like an island on the charts with a price bar surrounded on either side by price gaps. Long, purchasing, buying futures contracts to establish a market position that has not yet been liquidated through an offsetting sale. It's the opposite of short. Long liquidation. This activity is usually associated with non-commercial speculative traders and refers to the selling of previously purchased long futures position. Managed money. Large speculators. Speculative funds that invest on the long, buy or short, sell side, also known as non-commercial traders. Remember, they can make money going up and down. So they can go long, they can go short, they can do it every day, every minute, every second. You're not going to be doing that. Margin risk, the possibility faced by a buyer or a seller of a futures contract that the broker will demand more collateral or margin money. So in other words, when you're going long a futures position or you're going short a futures position, the requirement from the CME, Chicago Mercantile Exchange, is that you got to put up a bond, a good faith deposit of 5% on average. If the position moves in the opposite direction that you thought, there's going to be a margin risk, margin money. That's what margin risk is. This will happen when the futures position is showing a loss for a buyer, the price is falling for the seller, the price is rising versus the original purchase or sale price. The broker will still demand more money whether the buyer or the seller is a hedger who will get back in the cash market whatever he or she loses in the futures market. Minimum price contract, a cash forward contract with a buyer of the commodity that works like an option which guarantees the seller a minimum price for the sale of that particular commodity. We've talked about minimum price. It's similar to a fixed forward contract. You're basically just putting a floor in on your market price. Moving average, a statistical tool used to analyze the market's trend by toning down sharp price fluctuations. Essentially, it's a line that you draw. It's an average of all the ups and downs. It just smooths out the ride over time. Non-commercial. is also known as a speculator, who is a trader participating in the futures market who does not have a long or short position in the underlying cash market and is not involved in the production, processing, or merchandising of a commodity. Non-commercial basically is a speculator, someone who is essentially betting on a price rise or fall in order to make some money. Nearby contracts, the futures contract closest in time. In other words, for example, if it's February, then the nearby contract for Chicago wheat would be March. There is no February contract. New crop refers to the next crop cycle. Old crop refers to the current crop cycle. So if you've put in a crop in 2014, that's known as your old crop. New crop would be 2015. Open interest, the total number of futures or options on futures contracts that have not yet been offset or fulfilled by delivery. Option, the contract giving the holder the right but not the obligation, hence option to buy, call option, or sell, put option, a futures contract at a given commodity at a specified price at any time between the purchase date and the expiration of the option contract. So if you're a farmer and you're in the middle of summer and you don't like what you see in the field and you want to protect the price, you can buy a put option. Okay, you pay so much. So let's say it's beans. You want to protect that price at say 13 bucks a bushel. You're going to buy it at the money, $13 strike put option on the beans for November contract. If the price between August and November falls, you're going to make money. Options premium, for that option, you're going to pay a premium. The price agreed upon between the purchaser and the seller for the purchase or sale of a put or call option, which is non-returnable. So you're going to pay a premium. That premium is determined by the volatility, the time value, and then the intrinsic value. Where's the strike price? Is it at the money, in the money, or out of the money? Out of the money calls and puts. The strike price of the call option is above the futures price, while the strike price of the put option is below the futures price. Put option, a contract that gives the buyer the right but not the obligation to establish a short futures position at a specified price, strike price, by exercising the contract. Simply put, again, we went through that example with November beans. It's the same thing as shorting futures or physically selling forward to your local elevator. The only difference is, in this case, you're not committing to any bushels, you're still open to the cash market, you're still open on basis. All you're doing is protecting your price. You'll be more comfortable at harvest when you know exactly what that yield is, and so in the event that the price does fall, I want to protect myself with a put option. You don't want to use futures because you don't like margin risk, margin calls, so you just want to spend that 20 cents, 50 cents, whatever the amount is, and that's all you're willing to risk. Relative strength index, a technical indicator that relates the size of recent gains and losses as an index number between 0 and 100. The threshold values of 70 and 30 are typically used to indicate that the contract is overbought or oversold. So when you get to 70, you're overbought. When you get to 30 or below, you're oversold. Resistance, a price level the market has had difficulty moving above. We've covered this in part 1, 2, and 3 of technical analysis, so if you want to review it, go back to those videos. So you get to a certain point, like 8.49 in 2012 December corn, and you can't move much above that. That's a resistance level. Reversal, technical chart term suggesting positive price action after an attempt to trade lower, or negative price action after an attempt to trade higher. So a reversal could be where we're hitting a bottom in the market. Let's say it's wheat at $5 a bushel, and then the following day we get this big jump. So the trading day is wider than the previous day, and you get the higher closing highs and so on and so forth. That's a reversal. Doesn't mean that that trend may change, but it is a reversal. Scale up selling, the selling of an additional portion of a crop either in the cash or futures market as the market price rises in order to realize that price on that portion of production that is covered. In other words, you sell a little bit of the corn at 5, 5.50, 6, 6.50, you get an average as you go up. Seasonal index, also known as seasonality, is the tendency of a commodity price to rise and fall at a given time of the year. For example, corn prices have a seasonal tendency to rise during late spring, summer months when supply is at the smallest just before another harvest. Selling futures, to sell futures to make a legally binding promise to sell a commodity at a specified price at a specified given period of time in the future. If a seller is hedging, he or she anticipates selling the physical commodity in the cash market for whatever price it fetches at the time, with that cash price offsetting the gain or loss on the futures contract to ensure that today's price is what he or she will receive. Short, selling futures contracts or having sold to establish a market position that has not been yet liquidated or offset through an offsetting sale, the opposite of long. So again, it's in the middle of summer and you've got canola bushels to sell, and canola's at record highs at 700 plus a metric ton. You do not physically want to book forward. You don't want to take that physical risk with your local elevator. You don't like the basis, so you want to protect the price. You're going to short. You're going to do the opposite of what you are, which is long. Short covering, purchasing futures contracts to offset a short position. So sometimes you hear that in the industry where maybe the index funds or the speculators have been selling heavily. They're very bearish. Prices fallen. Remember in 2008 when corn hit a low of 305? Well, short covering would be where they all of a sudden stop selling. They start to cover some of those short positions, start to buy it back. They either cover it or add to their long positions. That's known as a short covering rally. Spread, the price gap between different futures contracts. So example is the spread between July and December corn. You're going to have a spread there. You sometimes hear a lot of talk about spreads driving the market. So there's many speculators that will play spreads. In other words, will the spread between July and December corn narrow or widen? Support, a level where buying interest is sufficiently strong to overcome selling pressure. So sometimes you'll get into resistance and support levels. We covered this in technical analysis, but a support would be where the price of corn drops to $5 and it stays there for a while. That's a support line. If you can draw connect the dots over a long period of time, that support becomes even stronger. Technical analysis is a study of past price and volume data in order to anticipate future market movements. Again, you want to use technical analysis when putting together your marketing plan. Time value, the portion of an options premium that exceeds the intrinsic value. So again, we've covered this under options. So if you're trying to protect a crop and you're either shorting futures or in this case you're buying a put option, okay, the time value is the difference. If you're buying a put option in the middle of July for December corn, the time value is the difference between July and December. As you get closer and closer, that time value decays. That's your worst enemy. Trading range, the difference between the high and low price of the commodity during a given period. So you get this trading range, right? Corn prices will trade between 5 and 6. That's your trading range. Maybe you need to sell the upper end of that trading range and avoid selling at the bottom end of that trading range. Trend, the general direction of the market. So if the market is rising, that's your trend. If the market is falling, that's another trend. Volatility, the measurement of the fluctuation, the price movement of a commodity over a period of time. Essentially, it's the movement of the up and down on a daily basis. It's a major component used in the theoretical evaluation of options price or premium. Zero-sum game describes the fact that commission fees and bid-ask spreads aside, the gain from a derivative contract by one counterparty is exactly offset by the loss to the other counterparty. In other words, for every winner, there's a loser. In summary, understanding again some of the most common terms used in the commodity market space can help towards executing a better marketing plan. Knowing how your industry operates is half the battle. The other half is understanding the industry jargons and terms. This new understanding and knowledge can give you one leg up in your marketing plan.